Hi, my name is Jeremy Green, Director of Advanced Planning for CBS Brokerage. Today we'll be discussing the topic of estate and marital deduction planning for non-U.S. citizens. We'll be discussing how you define residency briefly, gift tax planning, estate tax planning, and finally qualifying for the marital deduction using qualified domestic trusts. So first I'm going to start with how we define status of somebody who's a resident alien versus a non-resident alien. Basically, if you're a resident alien, you have a green card or you pass something called the substantial presence test. I'm not going to go into a lot of detail on that right now, but if you're a non-resident alien, you do not pass one of those two tests. So I'm going to cover non-resident alien status first. They are subject to gift taxes in the United States on their U.S. situs property for tangible assets. So intangible assets are not included in any gift tax ramifications. Although, for example, U.S. stocks, which is intangible, if they're sites in the United States, are actually part of the estate tax, including the gross estate tax, but not for gift tax purposes. Cash is considered a tangible gift, and they cannot gift split with U.S. citizens. And finally, there is no unlimited marital deduction. We'll be discussing how you qualify for something equivalent to that in just a second. Here's a chart I have of, and for a piece that we have got to, you can get by PDF, as to how to look at what happens when you gift from either a U.S. citizen or not a green card holder or a non-green card holder to one of those other three up top. So any gifts between spouses, of course, in the U.S. would qualify the unlimited marital deduction. The important thing to know for non-U.S. citizens are that there is a $157,000 annual exclusion for non-U.S. spouses, and that they use up their lifetime exemption when they go above that. Resident aliens are taxed on their worldwide assets just like U.S. citizens are. Non-resident aliens, as I said before, are not taxed on worldwide assets, just the assets situs in the United States. The definition of what situs in the United States and so forth is dependent on certain countries having tax treaties with us. They're listed here. We have this piece, like I said, get to by BPEF. There is also a flat capital gains tax rate of 30%, and we'll get into the estate tax aspects of the difference between these two shortly. The jointly owned property is included in the U.S. resident, U.S. citizens' estate, gross estate, if they are the one that gave the consideration for the asset, and only one half of that would be included in their gross estate at the first spouse's death. So, for marital deduction planning, if the surviving spouse is not a U.S. citizen, against no marital deduction, you can get the unlimited marital deduction if we put it in a qualified domestic trust, or if they become U.S. citizen by the time they file the estate tax return for the deceased U.S. spouse. So what you need to understand about the estate tax exemption what's important about this chart is that non-resident aliens have a $60,000 lifetime exemption. That's obviously significantly less than the $11,580,000 for U.S. residents or U.S. citizens. So how do we qualify for the marital deduction and that is the real opportunity here, how to qualify for the marital deduction, the unlimited marital deduction, and defer all the estate taxes at the first spouse's death to the second spouse's death, the way we do for U.S. citizens. And how we would do that is use something called a qualified domestic trust. The purpose of a qualified domestic trust is to ensure that the estate taxes that were deferred at the first spouse's death are actually paid. And so what you need to understand, that is the intent of this trust. So it has provisions that aren't found in any other trust. But foundationally, first and foremost, a qualified domestic trust is a marital deduction trust. And it fits one of the three definitions that we normally see for marital deduction trust. It's either a qualified terminal interest property trust, a QTIP, a general power of appointment trust, or a trust that dumps into the estate of the second spouse's estate when they pass away. So what we see here is that a qualified domestic relations trust is defined by the fact that it must have a U.S. trustee. The U.S. trustee is actually liable for the estate taxes inside that trust that are due. If it's more than $2 million of assets held in the QDOT, it must have a institution as the trustee, or a letter of credit must be applied for by the non-institutional trustee. Distributions from the QDOT income are income taxable to the surviving spouse, but they are not. But principal paid out from it is estate taxable, actually. So they can qualify for an exemption from that if there's a hardship, and they'd have to file a Form 706 QDOT, and that has to be paid. This has to be filed anytime a principal is paid from this trust, And the exemption for hardship would be if there was not enough assets in the surviving spouse's estate to pay for things like health maintenance, education, and support. And they must not have enough on their own personal assets to pay those things. But at the surviving spouse's death, those assets are estate taxable, and they're included in the gross estate of the deceased second spouse, non-U.S. citizen's estate. If you have a situation you'd like to discuss with us, please look us up on the internet. That's cbsbrokerage.net, or go ahead and call me at this number below, or email me here. I hope this has been helpful to you.